If you've been looking at the financial markets lately, you're probably scratching your head a little bit. I mean, on one hand, you've got these bright green lights flashing, go, 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 but on the other, you've got some serious warning sirens blaring. So what's the real story here? All right, let's just dive right into the heart of the puzzle, because today's market seems to be sending two completely different messages at the exact same time. We've got stocks hitting record highs, while pretty much everything else is screaming, be careful. How is that even possible? And this really lays out the core conflict we're going to dig into. So on one side, you have the big guys, right? The S&P 500, the Nasdaq, pushing up near all-time highs. But then you look at the other side, and traditional safe havens like bonds and gold, and even the super speculative stuff like altcoins, they're all telling a completely different story, a story of caution. Okay, to get to the bottom of this, let's play detective. We're going to start by looking at our first set of clues, these really dramatic moves in the kinds of assets people run to when they get nervous. You know, the classic safe havens. Just look at the sheer scale of this move into precious metals. I mean, a 40 to 50% surge in gold and silver, that's not just some tiny blip on the radar. That is a monster move. It's signaling some incredibly strong demand for assets that are seen as a safe place to park your money when things get uncertain. So why the heck is this happening? Well, a few things are going on. First, as bond yields drop, holding something like gold that doesn't pay you anything actually starts to look more attractive. Second, investors are using metals as a hedge, a sort of insurance policy against the fears of both a recession and inflation. And finally, with all the geopolitical risk out there, capital is looking for a safe home in physical, hard assets. These are all classic signs of people getting defensive. Now, this builds directly on our first clue. Just check out what's been happening with U.S. Treasury yields. We've seen this massive drop from over 5% all the way down to 4%, and it happened in just a few months. This isn't a small dip, folks. It's a huge shift in the bond market, and it's telling us something really, really important. So what is this drop in yields really telling us? Well, for one, it suggests the market is placing some big bets that the Federal Reserve is going to have to cut interest rates down the road, which is usually a response to a slowing economy. It also means investors are buying up government bonds like crazy, a classic flight to safety. This signal from the bond market perfectly lines up with and reinforces the cautionary tale we're hearing from precious metals. Now, let's flip the script and look at our second clue. This one comes from the complete opposite end of the risk spectrum. If all the cautious money is running for the hills, what is the speculative risk-on money doing? Just look at this. This chart shows a massive wipeout in what's called open interest, which is basically just the number of active trades. A mind-boggling $8 billion has been erased from altcoins. For comparison, only $1.5 billion came out of Bitcoin. This shows that speculative money is bolting from the absolute riskiest assets way, way faster than from the more established ones. The message here is unmistakable. The appetite for high-stakes gambling in the market is just collapsing. This is another crystal clear risk-off signal. It's like the party in the most volatile corners of the market is ending and the lights just got turned on. Okay, so let's recap. We've got gold, we've got bonds, we've got the riskiest parts of crypto, all screaming caution. With all of these warning signs flashing red, how on earth can we explain the fact that the stock market is just powering ahead? Let's explore the three main theories out there. Right now, there are basically three competing stories that investors are telling themselves. The first one is the super optimistic soft landing story, where the economy cools off just enough without crashing, and it's all supercharged by the AI boom. The second is something called the barbell effect, the idea that money is just going to two extremes, the safest assets and the highest quality growth stocks, leaving nothing in the middle. And third, there's the index distortion problem, which suggests the headlines might be hiding what's really going on under the surface. And this donut chart really gets to the heart of that thorough theory, the index distortion. See, the S&P 500 isn't an equal mix of 500 companies, not at all. A tiny handful of mega-cap tech stocks, what people call the Magnificent Seven, they make up a huge piece of the pie. Their incredible performance can literally lift the entire index all by themselves, completely hiding any weakness in the other 493 average stocks. So when you put all of our clues together, a really clear picture starts to form. It looks like a classic late-cycle market. The market is expecting slower growth, which usually leads to the Fed cutting rates. In that kind of environment, big tech stocks do great because of a flight to quality, while the risky stuff, like altcoins, gets dumped. And at the exact same time, the demand for hedges like gold and silver goes through the roof. You see? All the pieces actually fit together perfectly.
So, how can all of these things be happening at once? This brings us to the grand finale, the one single concept that ties all of these seemingly contradictory signals together.
And here it is. This is where it all clicks into place. What if we're not actually looking at a contradiction at all? What if what we're really seeing is segmentation? This is the key idea. Different groups of investors are all behaving in completely different ways based on their own goals, and it's creating these mixed signals across the entire market. This table just lays it out perfectly. You can see exactly how this segmentation is playing out. Cautious capital, it's hedging. It's seeking safety in treasuries and gold. Speculative capital, it's de-risking and running away from things like altcoins. And then at the same time, you've got all the passive and institutional money, which is often on autopilot, that just keeps buying the biggest and best stocks, all fueled by that AI story. They're all playing completely different games on the very same field. So the huge takeaway here is that the real story, the one happening under the surface, is way less bullish than what the headline charts are screaming at us. And that leaves us with a really critical question to think about. If the headlines are hiding the real story of a fragile, segmented market, what are the signals we should be watching to figure out what might happen next?